The dot-com bubble, also known as the internet bubble, was a period of unprecedented growth and investment in technology companies in the late 1990s and 2000s. During this time, investors were pouring billions of dollars into internet-based businesses, driving up stock prices to astronomical levels and creating an atmosphere of exuberance that seemed to have no end in sight. The bubble was fueled by a number of factors, including the growth of the internet and the rise of e-commerce, as well as a general sense of optimism about the future of technology. Many people believed that the internet would transform the way we lived, the way we worked, communicated, and the companies that could capitalize on this trend would be a huge successful. As a result, investors poured money into internet-based businesses, many of which were unprofitable or had no clear path to profitability. Valuations soared, with many dot-com companies trading at multiples of their revenues rather than their earnings. Some of the most well-known companies of the time, such as Yahoo, Amazon, and eBay, were the darlings of the Wall Street, and their founder became instant billionaires. The bubble reached its peaks in early 2000 when the Nasdaq index, which is heavily weighted towards technology stocks, hit an all-time high. However, by the end of the year, the index had lost more than half of its values as investors began to realize that many of the dot-com companies were not living up to their hype. The collapse of the bubble had a number of causes. One was the realization that many of the dot-com companies were not profitable and didn't have clear paths to profitability. Another was the tightening of monetary policy by the US Federal Reserve, which raised interest rates in an attempt to curb inflation. This made it harder for the companies to raise capital and for consumers to spend money. In addition, the collapse of the bubble was hastened by a number of high-profile bankruptcies and scandals. One of the most notable was the bankruptcy of online retailers Pets.com, which had spent millions on a high-profile advertising campaign featuring a stock puppet but failed to attract enough customers to stay in business. Other high-profile failures included Webvan, a grocery delivery services, and eToys, an online toy retailer, and lots more. The collapse of the dot-com bubble had a significant impact on the global economy, as many investors lost large amount of money and many companies were forced to lay off employees or go out of business. In addition, the collapse had a chilling effect on the technology industry as investors became more cautious about investing in technology companies, and many companies were forced to focus on profitability rather than the growth. However, despite the collapse of the bubble, the internet technology sectors continued to grow and evolve in the years that followed. Many of the companies that survived the collapse of the bubble went on to become major players in the industry, and new companies emerged to take their place. In addition, the collapse of the bubble paved the way up for many of the innovations and advancements that we see today. The lessons learned from the bubble led to a greater focus on sustainable growth and profitability in the technology industry. And many of the companies that emerged in the years that followed were more disciplined and focused than their dot-com predecessor. Overall, the dot-com bubble was a period of intense growth and investment in the technology industry, which was followed by a sharp collapse and a period of consolidation, with the bubble had significant short-term and long-term implications for the global economy and the technology industry. It also paved the way for many of the innovations and advancements that we see today.